All right. Well, welcome to episode 2 of what we determined to be the CRE News Hour. We're excited to share some interesting articles with you today. Henry, always a pleasure to see you, my friend.
Likewise. Let's have some fun today.
Absolutely. So I'm going to go ahead and try to go and set us up. We're going to present. All right. Getting ready right here. All right. If you can see, I just want to make sure we're seeing it properly. There we go. Okay. So first up, we're going to go ahead and go to Henry's article. So if you don't mind kind of giving us a little bit of feedback on this particular article, that'd be awesome.
Sure. Let's blow it up a little bit just so I can see it. One sec here. See it in full view. All right, amazing. All right, number one. So we're talking about industrial and retail dominating in the last few quarters, and obviously how activity has slowed down. We've obviously all felt it in some capacity or shape or form. Just talking about, I think this is an interesting point to bring up because, like we had alluded to in the past, I think it's important to talk about diversity of asset class and being able to maneuver and shift and adapt. While certain asset classes are not doing as hot, like we've talked about previously, I think this is a really great outline. There's just opportunity in the water. There's so much freaking opportunity in my mind. I'd love to get your thoughts. I mean, like you see in 2023, they said that it was a correlation to 2014. So we haven't seen market like this since 2014. And I'm curious how you're adjusting or how you can recommend people to adjust.
Yeah, I agree with you. I think, what's unique is that we really haven't had an opportunity to really go through like a quote unquote normal recessionary period. I mean, we kind of had one. We were going into one really pre-COVID, and all of a sudden COVID hit, and we went through a period of just absurd amount of spending, which created essentially quite a big of a bubble. So, I think quite based on our current environment in 2023, I think we're just having this massive shift and correction that hopefully into 2024 kind of begins to stabilize. But as we've kind of talked about even in the previous episode, that the sentiment from the selling side, it's going to shift. I mean, there's a lot of sellers out there currently that kind of have an unrealistic idea of what their property is actually worth. And so as we start getting deeper into this period of time where we're just not quite having a lot of transaction volume, those sellers that have to be able to sell are ultimately going to be able to, we're going to have to do that, come in the future months. So I think that's kind of, where I'm thinking. And I know we've kind of harped on that a little bit before, but I really, I appreciate the breakdown from the different property types as well, because, obviously we as you can see, I mean, the real beneficial ones, obviously multifamily has been transacting at a high level. Industrial historically is transacted at a high level as well. Hotels too, even post COVID, they performed extremely well. I know a couple of big developers that own a variety of different hotel product, and they've been doing extremely well post COVID as well. So I'm interested to see how it's going to play out over the next couple of years.
Yeah, I think that this is also a reminder that there is always going to be transactions occurring. I mean, even if you look in 09, there were still transactions happening. Not a lot, but there were still transactions happening. So it's realizing that, like right now, at least from what we've seen, is that I think that like the big difference, at least this is just my 2 cents, curious to hear yours, is that like the additional the transactional volume, because we're about half of what we were in 2022. Right.
Yes, correct.
I think that was from a lot of those people who were just like, give me a crazy number, and you were just able to achieve it because of interest rates being at the points that they were. Where like what I'm seeing is that like 2015 to 2019 is more of a normality, right? Like this is what normal looks like. We were at crazy highs, which is not normal, which obviously would not last. And like you had said, I think we're going to come back down to a brand new reality. It's got to shift hard first, and then it'll kind of plateau out. So, just being, focusing on, again, the top 3, the main 3, industrial, retail, multifamily, still cranking. There's a lot of deals being done, and finding a way to structure and find those great opportunities for investors right now.
Absolutely. I couldn't agree more. So what I'll go ahead and do is we'll jump into the next article, one that I found extremely interesting, and we'll go ahead and share. And pardon with us, guys. We're working through StreamYard right now, and it's the first time around. So as we continue to utilize this platform, we're going to continue to improve. So
sure. Yeah, and again, take these types of this information that we're going to be sharing with you guys, and like figure out how what's one slight adjustment you can make in your business, right? Like you're not
Mhm.
going to, like this is, we're trying to go through, really up to date news articles, which actually I saw the exact same one. The
You did.
same exact. I'm so happy
Mhm.
you chose this one. So this one means fun. This is gonna be fun to talk about. But it's like, how can you take one little piece of information from today and make some slight adjustments in your business so you can see some success? So talk about this one, Christian.
Yeah. So, if for those of you guys who know, obviously, WeWork has been under quite a bit of pressure on the financial side, and looking like it's more and more likely that things would eventually lead to a bankruptcy. As far as what led up to this point, if you guys have followed the story of WeWork, they were essentially subletting a bunch of space all across the cities around the world, and obviously New York, San Francisco, major markets around the country were beneficiaries of that. They were paying whatever landlords wanted, essentially, for a lot of their office space, and really didn't turn a profit at all. They were being propped up by significant investments by large firms, including SoftBank, which was their primary investor, billions and billions and billions of dollars. And the hope was that over time they'd be able to eventually turn a profit. Obviously, COVID put a damper on that, and most of the office spaces that WeWork has been occupying in the past, number one, weren't profitable, and thus they were trying. Now they're trying to restructure a lot of these leases, and for many of them, they're just trying to get out of them altogether. And so, it's kind of compounding the issue of what we're seeing in the commercial real estate space, particularly in central business district office markets. And so, I think that what's going to happen over the coming months, which again, this has kind of been a slow train wreck over the last several years, will eventually come to a head. And I think it's just going to compound the issues we're going to face in the office market in the next few years. So,
Yeah, I agree. I think that, by the way, have you seen the documentary about this one?
yes. Well, I haven't seen the documentary. I've seen some YouTube videos on it to kind of, and they provided, I'm assuming, similar, context. But
Sure.
what did the documentary say?
No, I basically just went through the whole. It's definitely. I wouldn't say it's exactly worth the watch. I mean, maybe you watch it and just watch the last 30 minutes because it kind of, the first 45 minutes is kind of just really slow pace, but you kind of get a taste for exactly what happened and leading up to the end, essentially, of the previous CEO, Adam Newman. I think what's interesting though is like I still think WeWork is a fantastic. It's a very interesting model, right? I want to say it's a great business because obviously they haven't really turned profit. I think in some markets it's really, really lucrative. In other markets, it's just really silly to do it. And obviously, we've seen, regular office space in general be devastated, but I still think this WeWork concept there's still a lot of truth to it, right? Like, like I have an office at Regis, it's just as a partnership we have with Regis. But I still think there's a lot of opportunity with it. I think that, it's funny. I've been watching this for quite some time now, kind of come to this point where like, I figure they're going to go bankrupt, and I'm like debating, because if you look at their stock ticker, I don't even know what it's actually trading at. Let me do this real quick. WeWork stock. I'm curious what it's trading at as of today. $2.38.
Yeah, which is crazy. I mean, the biggest thing that I think that is kind of a lesson learned, if you can draw from it from WeWork, was that it was trading as if it were a tech company, essentially. I mean, the multiples that they were achieving based on their earnings was absurd. And, I think that was just kind of in the midst of exuberance when it comes to all these different unicorn tech startups. And,
Absolutely.
Silicon Valley has just been kind of that watering hole for those types of ideas. And so obviously WeWork was one of those darling ideas that continue to grow over pre-COVID. And the crazy thing is, obviously COVID hit right before they were trying to go public, and then that caused a bunch of issues, and then there was an internal tumult where the CEO had to step down, and they pretty much forced him out. And I think they have to contend with the fact that you can no longer just keep pumping money into an enterprise if it's not going to be profitable. And so
sure,
they're just
crazy. I mean, like, they went from like what, $400. I'm looking at it right now. $400, peaked out at like $5 and change, and then came down to now trading at $2.32. I mean, like, it's just actually kind of crazy to think about what that's that story. But for takeaway purposes, what do you feel like is something that you take away from this kind of story?
Well, I mean, it's hard because I think the exuberance of what they were doing leading up to it, just signing leases for whatever landlords wanted because they had to be able to justify to their investors that they were continuing to grow at a rapid pace. I mean, that is not good business. That's not a smart business. You have to understand why you're going to be doing that. If you're not going to be turning a profit, and obviously this is a counter to the point of Amazon, because Amazon was going through a period of time where they were rapidly expanding, but part of their business logic is that they're trying to service as many people as possible and quickly deliver product, which ultimately helped capture market share. So their revenues were continuing to skyrocket, but they were just kind of kicking the can down the road as far as taking profit was concerned. And that's a much more sustainable idea than maybe in this case, where even in the peak times, their occupancy was not 90%. They were like in the 60s to 70% occupancy, even in the best of times when it came to WeWork. So
yeah, I guess this is like, something I've talked about in my coaching program, which is, just leading with profit, right? Like not scaling for scaling purposes or scaling for ego purposes, but scaling through profit. I mean, like there's no reason to, if I feel like this could have been such a fantastic business, long term. I mean, who knows what's going to happen through this bankruptcy? I don't know how much is actually going to drastically change, just because you see these companies that go bankrupt and then, they restructure a few leases and they act like nothing changed. But this is a really good point for this business, and for business sake, is scaling through profit only, and it's the only way to sustainably scale.
Absolutely. Oh, that's great advice. So next up is one of Henry's articles. So the housing market is getting colder by the day.
Yeah, I thought this was interesting to bring up, just because I'm seeing this a lot, and I'm sure with your audience too, where a lot of residential agents are now coming to this world of the commercial world, because they're like seeking savior. Help me, because this, the market is so tight on the residential side, and they're seeing a lot of there's just a much tougher market. So I wanted to bring this up. I mean, this is a really interesting chart where affordability is at literally an all-time low since the 80s, which is where interest rates were at 13, 14, 15, 18%. Absolutely. I mean, this is interesting. Right. And I think that this is another reason why, that they've had to skyrocket rates the way they have, the reason why Powell's been doing things that he's been doing. And honestly, did you see Patrick Bet-David's recent video about the interest rates and stuff like that?
I don't think I did. Yeah. What did he touch on? He
was talking about how he hopes that Powell does not get influenced to drop rates too soon, because obviously, if we don't really drag this out for some period of time, which, we're talking probably towards election time of next year, if we do it too quickly, he was talking about how we might end up being another Venezuela, where the stock market's incredibly high, but no one can afford it. Right.
Yeah. And, stagflation. You never want to get into a period of stagflation, because right now we're still contending with inflation where it's at. And for those of you guys who are listening, stagflation is where you have high interest rates. Essentially, the Fed's pulled all the levers they can, but inflation still is going through the roof. And then at that point, you don't want to ever get to that point, because then there's nothing you physically can do. You're kind of just along for the ride, and it does cripple economies. And you kind of see that in Venezuela. You've seen that, even post World War I, Germany went through a period of time where you could literally bring a wheelbarrow of money to a baker, and it wouldn't even buy you a piece of bread. Like the value of the currency had been debased that much. So, I'm sure we're not nearly that close to that. But again, it's one of those things where, you always want to tread the fine line, as they say. So.
Yeah, I mean, but what's interesting is that, prices really haven't come down much, right? It's just they really have gotten to a place where it is still kind of scary out there, right? I'm talking specifically the residential world, right? And even some in the commercial, where prices, again, have not changed so much. We're still hovering, at some, relative close to market, quote unquote, a year or two, even though affordability has drastically fallen off. So I think that, again, there is a wave coming. There's a massive wave coming of opportunity. And I think it's just those who are prepared will be in this cycle, will come out so powerful on the other end. And I think that there will be, hundreds of thousands of realtors who don't capitalize because there's just not enough transactional volume happening.
Yeah, absolutely. And I think, to your credit, especially with what you do on your channel, I mean, you're educating a lot of people, and not only just, commercial people, but also residential agents, and understanding that you can add this type of, you can add commercial to your repertoire. You can get more educated on it. You can start transacting in the market, because there are opportunities in both areas, obviously residential and commercial. But there's different verticals within commercial that you can explore that aren't just necessarily buy and sell, right? It could be leasing, it could be structuring deals like you're doing with owner financing. And obviously, you're buying and selling at that point. But again, you can get much more creative on the commercial side, whereas in the residential side, you can do creative financing deals and everything else like that, but it's not nearly as expansive as you can in the commercial end. So for those of you guys who are listening on the residential side, consider it. I mean, it really could be an option. Obviously, it takes time to get proficient at it, but this is the time to do that, especially in this period of time.
Sure. And I just I keep wanting to keep pounding this point, which again, we've talked about before, but it's like, if you cannot figure out right now that if you cannot be the source of opportunities, okay, where investors can make money, profitable, great deals, you will struggle in this industry. Right. This is an industry, especially economic times like this, where interest rates are at their at such highs in retrospect. If you're not focused on constantly trying to find these types of opportunities, you're going to be left in the dust. The deals will not be done for the next. They haven't been done recently, and they will continue to not be done in traditional facets. So it's educating yourself, like having conversations with your accountants and understanding tax law, so you can understand how seller financing can be beneficial and what aspects aren't. Speaking with, watching content online and understanding how to structure creative deals are going to allow you to capitalize in certain circumstances where other real estate agents are going to just, they don't want to list it. Goodbye.
Yeah, absolutely. Couldn't agree more. All right. So next up is an article I found on Globe Street. If you guys don't follow Globe Street, I highly encourage you to. They have some of the best commercial real estate content out there. But so U.S. commercial real estate debt grew by 5.9% in Q2. So as you can see here, the universe. So as it references here, the universe of commercial real estate mortgage increased by $320 billion year over year, or 5.9% in Q2 of 2022 to 5.8 trillion in Q2 of 2023, according to the Federal Reserve's flow of funds. So, what this indicates is that deals are still getting done. Now they're being more stringent about the deals that they're actually going with. And again, this is based on conversations I've had with lenders, both on the regional side. We've talked to some national lenders as well. Again, they're being a lot more selective about the deals they're doing, but don't use it as an excuse saying, hey, they're just not lending right now. People aren't doing deals. They're doing deals. It is happening. But again, they're just being more scrutinous about it. You may not get a spec build for 1.5 million square foot building done maybe in this environment, unless you're super well capitalized. But some of these other opportunities could present themselves. So kind of look at this as a way to say that even though transaction volume is down 50%, there's still opportunity out there.
Yeah, and this is also to your credit of knowing, having the relationships with commercial lenders right now and understanding their game as well as they do, so you can speak intelligently to the clients you're working with, which is, again, just talking about structuring great deals, because the deals that are being done right now, debt-wise, are ridiculous. Atrocious terms, ridiculous terms, things we haven't seen in quite some time. We're talking 40% down and 45% down, talking 8+% interest with 2-3% points up front. With also, in some instances for small mom and pop banks, you're looking at putting in $500,000 to $1 million worth of money in the bank to even get the loans done. I mean, it's like you're almost financing your own loans. So if this is why it's important to talk about structuring great deals, where we've been structuring deals with seller financing where sellers are holding back a decent portion of the down payment, right? Because it's very hard to be profitable when you're putting 50+% down, or 50-ish% down in totality, plus then construction costs. So it's like this is fantastic to point out. And listen, if you don't have a great commercial lender, find somebody in your local market and really understand the game right now, instead of just saying, oh yeah, I'm just trying to pitch a sell and not understanding how the loan side works. Right.
Absolutely. Yeah. I mean, and understanding that, you take the pulse on the capital markets and get an understanding of how the capital markets are operating and how they look at opportunities and how that idea shifts over time. Because I can tell you right now, these banks that I'm working with, and I'm not going to name names, but let's say I have 5 or 6 lists of lenders that I deal with on a regular basis. I talk to these bankers all the time, and they're telling me, well, this is kind of how we're operating right now. This is the type of, debt service we're looking at, or, whatever, metrics they're looking at. They'll relay that information to me so I can better advise clients or better advise investors to say, hey, maybe go with these lenders that this is the type of stuff they're looking for. So again, it's just becoming more creative, understanding what the landscape looks like, and then just executing. So again, I think that I guess the moral of this story is saying get educated during this period of time. And if you still got to get out there, you still got to hustle, you still got to make sure that you're getting deals in your pipeline. But this is a time that you need to educate yourself and become the expert that you need to be in order to ultimately come out of this thing and become a rock star. So
yeah, I mean, like to drive this point home, getting a better education and becoming the expert around the world of financing, the world of deal structuring, the world of finding and sourcing these deals. If you can focus on these 3 points, you'll be unstoppable in any economic times.
Absolutely. So next up, we're going to share it.
By the way, if you're watching this live, if you can give us some thumbs up,
please,
and, we would really appreciate that. As well as, by the way, you can ask any questions in the comment section down below. We'll make sure we support you in that as well.
Definitely. All right, next up is one of Henry's articles. So U.S. industrial tenant demand slows further in third quarter.
Yeah, I thought this was interesting in the sense where just because there's industrial transactions happening doesn't mean all over the country that you should be investing in it and trying to sell your investors on buying it. Because in some markets, it's still probably the best asset class you can get your fingers on. However, in other markets, I think it's something that I would be hesitant to looking at unless the deal's absolutely out of this world. So this is just showing tenant demand, like you had mentioned, where leasing activity is, I mean, it was crazy. I mean, if you look like we talked about, like the normalcy in regards to 2014, 15, 16, 17, 18, 19, and then 2020, 2021, where it starts kicking off to these ridiculous numbers where there was so much demand for square footage every quarter that they had to build. I mean, like it's like the housing demand right now. And now we're seeing such a crazy pullback, a huge pullback, where we're actually dipping below. We're almost at the lowest points, since maybe some parts of 2018, 2014, 15 or something like that. So it's just keep this in mind that, like, if you're focused on industrial leasing, maybe it's focusing on better markets where that is where there's more transactional volume going on, where there is more demand, instead of just saying like, oh, well, I do leasing in this city because that's where I live. It's saying, no, I do leasing everywhere because this is, or in this specific area, because that's where demand is.
Definitely. Yeah. And understanding the landscape of each of the markets. I was just at a regional conference for our region. So I'm located here in Louisville, Kentucky. We had people drive down from Indianapolis, Cincinnati, Nashville area and such. And they were giving like an industrial market update for the region. And a gentleman that works at a firm that they own product all over the country, but they have a contingent of a property in the Midwest. He was even mentioning that in the Indianapolis market, particularly the southern Indianapolis market, they had a lot of available property in that 500,000 to 1 million square foot range. And so if you're kind of playing in that sandbox, you're kind of at the mercy of the tenants. Whereas if you start getting into smaller product like a 100,000 or 25,000 square foot building, you have the flexibility to now offer it to a multi-bay industrial, and that is still very active. And I'm sure a lot of parts of the country that's the case. But again, if you play in that 500,000 square foot sandbox, the tenants it's kind of shifted in their eyes and in their stance. I mean, the tenants have more power now than they did in 2020 and 2021. And maybe that's unique to Indianapolis. I doubt it is. I think there is obviously a shift happening there, but
well, I think that it's more so also of these large corporations. You take Amazon as an example. These these companies, they it's not like they have endless expansion options here, right? Like they needed the extra expand. They needed to expand the way they did because of the demand through COVID. Now that is not the same anymore. Right. They also have now acquired all these locations, which I mean, like there was even articles out months ago where Amazon was subleasing some of their space because they don't have a lot of their space. Exactly. Yeah. I mean, by the way, they actually also just signed one of the largest leases in the country in San Francisco. They just signed a major million plus square foot lease out there. And it's just important to pay attention to like these. It's not like the demand will not be endless from these huge corporations, because Amazon was one of those leading companies where now that they have all these space and now they're kind of over expanded, in these areas. They don't need the space anymore. So it's like you had mentioned, I think that where the value is now targeting these smaller flex spaces, maybe a few 100,000 square feet of flex space where you have a little bit of office in the front and then a large percentage of it being warehouse where you can rent it out to multiple tenants instead of these big, huge corporations.
Absolutely. Yeah. I would agree with you on that. That's what I'm seeing locally here. And I'm sure it's not specific to my market, but I'd love to hear if you guys are watching this, comment in below as well to tell us how it's operating in your market as well. And I will go ahead and pull up the next article.
Yeah, I mean, this is also like why it's so important to play state. I play statewide. That's my game. I'm a statewide and now touching nationwide or nationwide, where you have this ability where, like, if you're like, I've sold in my backyard before. I've only sold in my backyard before. I've heard those real estate agents who go like, "Oh, I just sell in my county." There is not enough transactional volume in your county to pay your bills, right? And it's taking moments like this and all this information we try to share with you to keep pounding down and saying like, hey, maybe I should start prospecting statewide and maybe I have to drive 2 hours to do a deal. I live in Miami and I sell hundreds of millions of dollars worth of real estate in New Jersey alone, and I'm not there. I don't see the properties. So it's like, keep in mind, like, you don't, just because you get a lead or a property that, or an opportunity along your desk doesn't mean you have to live 2 minutes away.
Yeah, 100%. And especially for those who are listening that aren't necessarily in major metro areas like a Miami or a New York City or a LA or San Francisco, because I imagine in some of those markets, you could probably get enough in a particular area to justify it. But expand your geographic footprint, in particular if you are in an environment where it makes sense.
I'm even mentioning for the people I'm working with here, my team down here in Florida, it's like, get out of Miami, like prospect outside of Miami, because like, just like in those crazy metros where like no one's still paying these crazy, ridiculous $300 plus per square foot, let alone for industrial. But like, it's just like, get outside those major metros, go into secondary and tertiary markets. I mean, that's where we're seeing a lot of opportunity for investors to still make some great returns.
That's awesome. All right. So next up is commercial real estate forecast / for 2024. So this is based on the Mortgage Bankers Association. They slashed their forecast for commercial real estate production next year and lowered expectations for this year by 12% as it finds delinquencies are continuing to rise. The forecast released October 19th contained the MBA's first major change in its 2024 forecast for a total and multifamily loan originations. Production for this year was revised downward by 23% on August 3rd. For all loans and 20% for multifamily. So again, it kind of lends the same logic. It lends itself to that banks are becoming a lot more picky about the loans that they're doing. Obviously, this doesn't mean that they're not lending. There's still volumes that their metrics they're trying to hit. Maybe those have been modified slightly, but again, there's still deals being done. But we're not going to sugarcoat it and say that banks are just absolving or not even looking at things like they were previously. So
yeah, and I think again, this is great to pay attention to, where think about it like this. If hypothetically you knew, because you had insider information, because in real estate it's not illegal, we have all this information and we can make judgment calls and it's totally legal, right? That we're supposed to be doing it. And it's like, if you knew that banks will treat X asset class differently and harsher than other asset classes, why would you continue to try to do deals where it's more complicated? Why would you push in a direction where you're pushing a boulder uphill versus downhill, right? There are asset classes like office and mixed use deals right now that have much worse terms than traditional multifamily or traditional industrial or retail. And it's like paying attention to these things. Like multifamily's always had the best terms of any asset class, right? At least for the the last
100%. No, you're right. You're right. I mean, you can get 30-year loans. I mean, it's certain depending on the loan product. You can get longer amortization loans with multifamily, whereas with other product types, not quite the same terms. So
yeah, it's like why? Yeah, right. So it's like why? Like I've had some of my salespeople recently where they bring me a mixed use deal and they're like, oh well, the price per square foot's fantastic, or the cap rate on this deal is fantastic. I'm like, it better be, because they're not going to get a great loan on this, right? It's just infinitely more complicated to get a loan on these types of deals. So keep this in mind. Again, like we've been talking about, it's like, if you're going to be prospecting something, which all of us have spent time lead generating, or at least I hope so, every day, you should be prospecting things that have the easiest ability to sell on the back end. You want to read some of the comments here?
Yeah, sure. You want to go ahead? We can go ahead and do so. NVS TRZ34. He said, "Thanks, guys. We appreciate you watching, man." Vadim, he asks, "Where would you gents recommend concentrating on for a new agent? I am new to agency and have been in the biz for over a year now and had several fall through due to financial issues."
First off, we get it. We get it. And by the way, this will be a continuation, similar to what we just brought up, where the financing is going to be a major issue. You want to rip before I go? I'll go after.
Yeah, I mean, I can definitely empathize with that. I actually had 2 deals recently fall apart because of financing, so I can definitely empathize with that. I mean, really, as far as new agency, you just gotta. I hate to say it, you just got to continue to compound the payment. Try a variety of different things. I know Henry's phenomenal as far as coaching when it comes to prospecting. I think that should be the number one thing in your repertoire. Along with that, you really need to get out there and start building a brand. People got to know what you do. So whether you're focused locally or focused nationally, I'm always big into trying to get out there, start posting on social media, start creating a channel. I write books, so I've created a bunch of books, created Audible books. There's so many different verticals that you can expand, and really it is a multifaceted approach when it comes to building a brand. It does take time. I mean, my first year, I didn't do that well at all. I think I've said it many times. I think I did 13,000 my first year. So it is a brutal business to start off in, but subsequent years, I continue to improve. And now I'm on year 4, and this is shaping up to be my best year in the business. So, knock on wood, but again, it just takes time. It's the compounding effect. If you haven't read the book, The Compound Effect by Darren Hardy, I highly encourage you to read it. It's the small, consistent actions every day that lead to the positive results.
Yeah, love that. Yeah, and I love how you brought up one of the things I always talk about, which is commit to for the long term. I mean, like I'm committed. I got 30 more years in this industry. Like I'm committing for the long haul, right? And it's like just because this year might be a little bit slow or anything doesn't mean that over the 30-year window I can't win, right? So if you give yourself a goal to earn $1 million a year, and you said I'm going to be making $1 million a year in, by the time I'm X age or 20 years in the future, 10 years in the future, it's almost inevitable for that to happen because you give yourself enough runway to achieve your goals. But so many people are like, I want to make $1 million in the next 6 months. It's like, you're probably setting yourself up for failure. So in regards to how to, for financial issues, what I recommend is really understanding deal structuring. I think that's a huge, like these two things play so much, a huge roles in people who are closing deals right now, which is number one, finding better deals. And number two, structuring better deals, right? So obviously this deal sourcing on finding better deals is finding more off-market direct-to-seller deals that are priced appropriately, because the better price they are, the better the deal makes sense, the easier it is to find financing, right? So number one, find and negotiate better deals. And then on the second side, which is on the structuring aspect, learning everything that there is in regards to seller financing and creative financing strategies so that you can put deals together where they might not be able to put down less than 40%, but it doesn't mean that the buyer actually has to put down all 40% of that money, right? You can have the seller hold 20% of that and have the seller not make, maybe, you could not do payments for the first 6 months. You could say, or you do you do 3% interest. We've been structuring these where it's like it's 3% interest on half of it and 6% interest on the other half, right? Where it's like we just need to make sure that like X per part of that deal where there's enough cash flow to substantiate the loans that they're getting, and we're able to structure much better deals. And it's like we try to structure all of that ahead of time. So it's learning how to underwrite, learning the process of deal structuring. So you're like, we try to solve those problems so much upfront. So by the end of it, it's just like there's no question they're getting a loan on this deal. Of course they are. Right.
100%. Yeah. And understanding too, and I know Henry doesn't do a lot of this side, but leasing is also an option. I mean, I do a lot in the retail leasing space, and there's different ways to structure deals where you can maybe find a building that could be a great fit for a particular tenant. And then you say, okay, you buyer, buy this building, we'll put the tenant in there. And then, now you have an investment property, right? So
exactly.
There's very creative ways you can structure this deal. And that's one of the fascinating things about commercial real estate. You can really explore a bunch of different verticals. And, there's not one size fits all type approach. So,
yeah. And actually we've been doing a lot of like lease backs and structuring it where it's actually like we're buying a vacant building. Like I'll give you an example. We're looking at a building right now. I think it's like, I don't know, 40,000 square feet, completely vacant. And it's a great price per square foot, but it's a terrible investment unless we structure it in the sense where the contingency in the letter of intent that we're structuring is that it's contingent upon leasing out the building prior to close. Right. So it completely takes all the risk off. Right.
Yeah.
And we know that we could easily rent this building out and make, a 12% cap rate day one, based on the price per square foot. And the seller's like, as long as I get my price, I don't really care. So,
yeah, and the same thing goes with zoning too. I mean, we talked about on your channel, talked about on my channel a lot, like rezoning property and understanding that if you can get the right zoning, and it's all contingent upon getting the rezone. If you get the right zoning, you immediately added equity to that property. And so again, just getting very creative with that sort of thing. All right, so next up, Jessica, she mentioned find a local bank, and I would definitely agree with you on that. I think
always helps.
Absolutely, local relationships help because of the fact they really understand the market and the dynamics within that market. Most of the lenders that I've dealt with in the past have been either small local banks or somewhat regional banks as well, and they tend to be the ones that kind of bite more than some of the national brands, unless you're talking some big buildings, and then obviously they become more of a player. So. All right. So next up, Jessica says, yeah, we should meet. So she is in Louisville. I'd love to meet. Always looking to build lending relationships. So definitely looking forward to that. Brandon, he said, how we doing today, gents? Enjoying the convo while skip tracing owner info. Greensville, South Carolina broker here. Yeah. Brandon, how's it going, man?
How we doing? We appreciate you watching. We appreciate you tuning in. But it's, again, for skip tracing software, just for 2 cents real quick. I don't know if, I'm curious to know what you're using as well, but typically we're pulling data from Reonomy, CoStar, which, by the way, if you're looking to do some cold calling or some prospecting, make sure like we're pulling our lead list from CoStar, Reonomy, and PropStream. We then pull that out. We skip trace it through a software called Batch Leads. We've seen some great success there, and we'll throw it into a dialer. And that's how we rip through.
That's amazing. Okay, so
next, and we appreciate you doing it.
Yeah, of course. And we'll do one last article that Henry has, and then we will kind of go back to the dialogue. Feel free to continue to type away, guys. Looking forward to hearing and answering any questions you have. And really, you guys could engage in the dialogue too. This is one of the reasons we decided to start this, was to kind of continue to build that real-time dialogue. All right, so this. So Vicky strikes a $433 million deal with bowling center operator Bolero. Nice.
Okay, so the reason why I wanted to bring this up, similar to what we actually just brought up, which is there are large corporations, there are companies right now, successful companies. Bolero is on the stock exchange. Okay, like this is a major corporation who is doing a major lease back. This is insane, because the reason why I think this is so cool is because, and this happens at every level, guys, where there's deal opportunity. Whether you have a huge corporation that just sold off all 38 properties here for $433 million. And if you scroll down, you'll see that they're getting this deal, which they're, Vici is a huge investment company. I just wanted to go down to the cap rate real fast. 140, 49 casinos. I don't know if I remember being like a 7 cap.
Yeah.
There you go.
Yeah.
This is a huge deal that's being done where it's like these companies are selling. This company, Bolero, just sold for $433 million, and they're doing an annual lease back of $31.5 million, representing a 7.3% return or cap rate on this deal, with a 25-year lease with 6 5-year option renewals with escalations every single year, 2% max out at the CPI. This is so awesome to me, because we're seeing deal opportunities where, like, if you're wondering where deal opportunities are, there are companies that are doing well and would love a cash injection. Bolero would love a cash injection of $500 million, pay off as much, any debt that they might have, clean off their balance sheets, and just be able to rent and still be profitable. So it's finding these types of opportunities. I just was like, I love this. I love seeing this. I wish I was Vici, finding deals like this. This is fantastic.
Well, and it's also understanding how to talk to owners, because a lot of times when you call an owner that owns a property, you say, hey, are you interested in selling? And they'll be like, no, I'm not really that interested in selling. But if you can kind of explain the value proposition of even executing a sale and leaseback, for example, I mean, especially in this environment where the capital markets are tight. I mean, maybe they want to go and expand into a new market, but maybe they're banking relationship has decided to kind of pull back a little bit because of what's going on, like one of the best ways you can access that capital is to just tap into your equity. And by doing that, by selling your property and taking the cash and then using that money to go do what you want to do, there's a lot of benefits to it. And so if you can have that value proposition, obviously that's super beneficial. And one of my buddies who's also a broker, Logan Hartle, he's done that quite a bit in the past as well. So very smart opportunity.
Huge opportunity. And we're seeing like right now, one thing that we're targeting is we're pulling lead lists where individuals have bought properties where they bought them at steals. They bought them at $50 to $75 or less per square foot in great areas. And they've owned them for like these properties haven't traded in the last 10 years. They've owned them for sometimes 15, 20, 30 years where they owner occupy the building, and we're able to structure now that, they bought it at $50 a foot and now we're offering them $122 a foot and they're making a great return, quote unquote, on their building. However, we're buying it at a fantastic price. We're structuring an +8% cap rate day one plus increases where in a 5 or 6 year period of time, you could be at a 10 or 11 cap. It's like there's huge opportunities for investors to make money on these leaseback deals.
Awesome. Well, great. I mean, that's kind of all we had as far as the articles are concerned. Love to hear you guys type away in the chat box. We have a few more minutes left as well, so feel free to type away. Henry, do you have anything you'd like to add in the meantime regarding any of the things we've talked about today?
Yeah, well, I think that it's like taking time. Like Warren Buffett reads 8 hours a day, right? And just constantly has their pulse on everything that's going on in their local or his is a global market, right?
Mm-hmm.
And he's reading all these different things about what's going on every single day in his market per se. And it's like, take some time, 15, 30 minutes a day to really start digging into your local and general vicinity market wise and understand what's going on. Where is there opportunity right now? Where is there a huge development going on? Where is there, a lot of money being invested? Where is there this, huge corporation moving into your geographic area? Where are these opportunities happening where like, hey, if I bought the property next door, right? If I bought the property in that area, in that secondary or tertiary market, maybe I'm going to I know for a fact, because I have this information, we can make some money there. We're like, hey, there's a huge development going on in this city. In this specific this specific lot was just bought for X and there's going to be this huge development. It's like, why are you not looking at the land adjacent to it and trying to lock up those deals? There's going to be huge opportunities there.
Absolutely. All right. So we got some questions coming in. So Brandon, got a question for you guys. I am just a year in the business and have an off-market industrial property listing that I got from a cold email. What would be the best way to find a potential buyer when you don't have a buyer? Okay.
Great question.
Good question. Yeah.
Go for it.
Yeah. So, I mean, first off, my question first off is that your focal area, or is this just something that you kind of just, have built up over time? I guess one thing that I would probably say is that if you work with a larger firm, if you don't necessarily have a buyer, maybe even teaming up with someone that may have a buyer and try to see if you can get at least something out of it could be a potential option. Henry, I don't know if you have any recommendations.
Yeah. So our typical steps for it is wherever that listing is that you just got. By the way, kudos to you. Cold email. We love it. We love that. What I'd recommend is that you're calling every single property within a few mile radius, okay, in that city or maybe a city adjacent that has sold in the last 12 to 24 months that is similar. Call up that owner because they just bought and they just proved that they're expanding. They're buying properties in this area. And you basically can call them out. Look, let's just say your industrial building is 25,000 square feet. I would call every single industrial building that's sold between 10,000 and 50 or 100,000 square feet locally and say, hey, I have a property at 123 Main Street. I saw you bought a property at 12, whatever it was at whatever street. And I was curious if you'd be open to buying another property locally for another, similar to what you have. So, and we're finding that like most investors typically are always buying more stuff, right? So that would be probably the first place I would start.
Definitely. And then over time, as you build those relationships with those investors, then obviously those just become the people you talk to when you find those opportunities. So
exactly. So my best friends today are from cold calling investors all over.
That's amazing, man. All right. So next up, we have, what kinds of tracks will you guys look to be using when sellers will want to hold on to their properties to brace for the market impact? Will you lean on their equity becoming less and less?
Okay, like word tracks, like scripting. By the way,
Yeah.
if you have questions about scripting, in my YouTube description, I have a script book, which I would definitely check out. I spent months rewriting this thing. I think it's really well done on the commercial side. So definitely check that out. In regards to individuals who want to hold off for the meantime, I think that it's digging into their why and understanding like we facilitate transactions when individuals are ready, right? And, and if they're not ready, you're not going to make them ready. You're not going to say some magic words that's going to get them to consider selling. But what you are able to do is educate in today's market.
Mhm.
If you do X, like give them options, right? Give them X. Like if you do X, this is what will happen. If you do Y, this is what will happen. If you do not sell right now, which is an option, this is what's going to happen over the next year, 2 or 3. And this is what you can expect. Like I have some guy who's like, he's considering selling one of his buildings, 20,000 square foot mixed use building in a very nice location. He's like, I'm debating on not selling it just because I don't want to pay taxes, right? He's got a lot of equity in the building. He only has like $600,000 mortgage for a building that's worth probably around 3.5, 4 million. And he's like, I'm considering not selling the building because I don't want to pay taxes. Listen, no one on planet Earth would blame you because nobody wants to pay taxes. But if we were able to like, what do you want? He's like, well, I honestly hate managing this building. Okay. Was like, okay, well, if we could structure a deal where you got paid a very healthy amount of money, that's something that you were agreeable to, where you locked away some money up front and you had monthly payments over time that you were agreeable to, could you consider selling the property? He's like, yeah. And this way you don't have to, pay X percent in taxes because it's a seller financing deal. And he was very agreeable to it. So it's like really digging into their why of why they're looking at their pain points.
Amazing. That's amazing, man. Yeah. And understanding too, it's, sometimes what, I've had conversations with sellers who are kind of debating whether or not they want to sell. And because of what the impact of the market shift has occurred. And a lot of it is like thinking about, well, it's more about reallocating your equity or reallocating capital because not only is your property suppressed, but other people's properties are suppressed too. So if you can find an opportunity where you can reallocate that capital or the equity that you already have and put it into something that you would actually want to own, because a lot of times with these sellers, as you had mentioned, maybe they're tired of having to manage this type of property. Maybe they have a residential portfolio, or maybe they have a property that's kind of a skimpy property they don't really want to deal with anymore. It's just like the only one left in their portfolio that they've kind of held on to. So it's like you kind of flame it in that way and say, look, instead of you having to manage this and continue along, why don't you just reallocate that into something else? And then your life and your paint the picture for them after this sells. So that's just another way to kind of put the
super well said.
Yeah. All right. So next up, Brandon, he said, know many investors at all as a newer agent. I guess. Oh, so you're asking us if we knew any investors as a newer agent?
Yeah, I mean, I think that it's important to note that most individuals, I don't care how old you are, right? Newer agents to the business in general, don't just walk in typically with connections, right?
Mhm.
And as simple as going to a local real estate meetup, as simple as talking to local brokers in your market, like you had alluded to, Raphael, to get started, to start making cold calls to properties where like, hey, would you be totally against selling your property? And they say no. Be like, okay, no problem, John. Just curious though, do you happen to often look to buy properties and add to your portfolio? Would you be totally against buying a property? I know you're not looking to sell. Would you be totally against buying? It's like those conversations all of a sudden turn into like, oh, this guy owns 15 properties and looks to buy a property or two every year. And it's really that simple. It's just doing the work for it.
It's amazing. Yeah. Yeah. And I'll say this with me, when I started locally, I'm not from Louisville originally where I'm located. So I have no connections whatsoever. A lot of it is just like Henry said, is just getting out there, talking to people. I got involved in meetups. I started a meetup myself and I met a lot of investors locally through that, built those relationships. And now I have a pretty long list of people that I can reference and understand exactly what they need and asking requirements, right? And actually documenting those requirements so you can reference them at a later date when you actually come across something, right? Because you can't internalize every single person's criteria. So that would be my recommendation.
Absolutely.
All right.
Absolutely.
So Brandon says that makes sense. I work for a BHSS franchise.
Berkshire has.
I'm sorry. Okay. And
That's a resi.
That's a resi. Yeah. So that we have 500 residential agents and 8 or so of us are in the commercial office. I just turned 30 earlier this month and I'm the youngest by 25 years. Yeah. It's not an uncommon thing here in the commercial space.
Definitely get that.
See, so he was mentioning only 6 comps within 30 miles that have sold in 24 to 24 months, or 2012 to 24 months, because it's a unique retail / industrial building, because it's only 2,650 square feet, worth about 250 to 275K. I had it listed over the summer, but got told bad information about cap tax exchanges, ended up paying 10K to get out of the first contract over the summer to sell. So suffice to say, when I first met him at this place, he wasn't too happy.
Jeez.
Yeah, that's unfortunate. I'm sorry to hear that. Well, that's a learning lesson, right? I guess, right?
Yeah, I mean, this is also why I'm a huge fan of the different side of the game, which is, just listing this property for sale, especially at a price that would not cause it to sell, often makes a tougher relationship between you and the client. And typically you can create a better bond by saying like, hey, I'm not saying, you can go through the script, which which is in the script book, which is, would you be totally against having me market your property? Not mentioning the for sale piece, right? Like, is this way? It's like, would you be totally against having me market your property, and having it in the sense where I'll just bring a buyer. And on this case, if it's really worth 150, 175, make an offer at 150 or 175 first, get the price point into a point where now you can actually start negotiating something off market instead of just listing it on the market and hoping and praying.
That's the great advice. And again, part of our jobs as agents is setting expectations, and it's hard early on, but people will respect you a lot more if you tell them like it is and say, look, this is what we need to be at. And the better thing too is if they decide to go against your advice, and then over time they come to the realization that your advice was right, it just makes that relationship more strong long term, and then hopefully you continue to deal with them over time as well.
Exactly.
Cool. All right, so it looks like we got plenty of questions answered. So I'm glad we're able to do this again. This is episode 2 of the CRE News Hour. We've been doing this. We're continuing to do this every week. Looking forward to kind of engaging with you all in this medium going forward. Would love to hear your feedback as well. So if you guys are watching this on YouTube, LinkedIn, wherever you guys are watching this, please type away in the comment box. We're going to go ahead and review this, and over time iterate to make this as best possible medium we can make it. So.
Absolutely. And we're going to start doing this a little bit more regularly on Wednesdays, I guess, right? We're going to choose one day of the week. We're going to go live at the same time, try to make it super consistent for you guys so you can find us at the same place every week at the same time. Number one. Number two, if you come across anything interesting, make sure you let us know in the comment section. If you come across a certain article or a certain topic or anything that you'd like us to jive on or to have a good fireside chat on, make sure that you let us know in the chat. We'll make sure we rip on that in the following episode. So besides that, we appreciate it. We appreciate the love. Make sure you give us a thumbs up, love the content, and make sure you subscribe if you haven't yet already.
Absolutely. Well, guys, thank you all so much for tuning in, and we'll see you all next time.
Take care, everyone.